All right, let's get started. This is a webinar from Pasco Hernando SCORE, tax implications for small businesses. Just take a minute and talk a little bit about SCORE, what it is, what our mission, vision, and goals, and the services that we provide. Mission to SCORE. SCORE was founded in 1964. We're a resource partner of the Small Business Administration. They provide some funding for our organization, and we've been working with them for a long time. Our mission is to basically to create a vibrant environment for small businesses, and our vision is that anybody that wants to be in business, is going to have the necessary support to be able to do that. And of course, one of our core values is that our clients' success is our success. And then we really believe that. The kinds of things we do to help people in business, provide free business advice and mentoring. I think that's one of the key things that we do. If you need help with your business and any aspect of it, you can request a mentor and get on one-to-one, personal help with people with a lot of business experience. So it's just something to keep in mind. That is a place to get SCORE, is a place to get the help you need if you can, you're starting a business, or you want to improve the way you're running your business, or you've got any other business issues. We can definitely help. We also offer no-cost training. That this webinar is an example of that. And we have a lot of business templates, resources. If you go to our website, pascohernando.score.org, or you go to the national website, just score.org, and look in the libraries, you'll find tons of articles, webinars, things to read, templates to use that can help you in various aspects of your business. Again, that's just something to keep in mind. SCORE, we have over 10,000 volunteers all over the country, serving about 100, as it says, 1,500 communities. I think there's about 320 chapters around the United States. As I mentioned, we're the Pasco Hernando chapter here in Florida. SCORE does have an impact on the United States in terms of what we did last year. We actually created or helped to create 45,000 new businesses. For those jobs that were non-owner jobs, we helped create 74,000 jobs, and total jobs, including the owners and the people they hired, almost 120,000 jobs. So SCORE does have an impact on business and on the economy, and we did help over almost 600,000 mentoring sessions with entrepreneurs. So we do have an impact, and we're here to help and to be able to provide support for anything that you want to do with your business. So let's get started. What we're talking about today is a number of various aspects regarding taxes and your business. First, we're going to talk about federal business tax entities, state business tax entities, which aren't really the same as federal. Talk about how you elect the type of business that you're in, basically how you tell the federal government what your business is about. Talk about state and local licenses, those things that might be necessary to have for your business. And then we're going to talk about business taxes, both federal and state taxes that you have to pay as a result of being in business. Talk a little bit about business income taxes, touch on insurance and what things that might be useful to have for your business. And then talk about record keeping and estimated taxes, which as a tax preparer myself, those are key things that are going to help you be able to deal with your business taxes. All right, let's talk about federal business entities. There's always a lot of confusion, I think, between what's federal and what's state, and the federal government only recognizes 4 types of businesses. A C corporation, those are stock corporations. An S corporation, which is a simplified corporation structure. A partnership, and a sole proprietor. Those are the only 4 that they recognize. I know a lot of you, and some of you may have already created an LLC. LLCs and LLPs, limited liability partnerships, are state entities. They're not federal entities. The federal government doesn't know what an LLC is or an LLP is. So if you have one of those, if you have an LLC, for instance, limited liability company, you can elect to have that LLC treated as a corporation, a partnership, or a sole proprietor, depending on the circumstances. So an LLC is it's a legal entity that's created in the state, but it has no relationship to federal taxes. So you have to decide how you want to view that business from a federal perspective. If there's more than one person involved, it can't be a sole proprietor. If there's multiple people, it's going to be, your business would have to be treated either as a partnership or a corporation. Those are decisions that you would need to make. One thing I would point out is that when you're talking about business entities and taxes, the best friends you're going to have is a good attorney to help decide on the nature of your business, and a good accountant or tax person to help you navigate some of these tax issues. So a lot of people, I think, are reticent to spend the money on stuff like that, but in reality, having those people as business partners is ultimately going to turn out to be a good investment. So let's talk a little bit about these federal business entities. A sole proprietor sort of says what it is. The words kind of say it. It's a business owned by an individual. The individual then carries unlimited liability for whatever happens in the business. If you do work for somebody and destroy their house, you're going to be liable for it. Nice thing about sole proprietors is that they're easy to set up. It kind of starts when the owner wants to start it, and it ends when the owner wants to end it. From a state perspective, there really is no licensing for a sole proprietorship, at least not as a sole proprietor. And the last thing about sole proprietors, there's no distinction between you and your business. So your business finances and your personal finances are really one and the same thing. When you do an income tax as a sole proprietor, it's just basically something that gets added to your personal income tax. It's not a separate tax return for your business, because the business and you are kind of one and the same. Partnerships. Partnership is when a couple of people get together and they contribute money or property or skills, and they decide they want to be in business and share the profits and losses of that business. Partners can be individual people. You can have members of partners, and partnerships can be other partnerships. They can be corporations, trusts. So you can get some real involved entities when you start talking about partnerships. Partnerships do have to file an annual tax return as the partnership. They don't pay any taxes, but all of the profits or losses of the partnership get passed to the individual partners, and they declare those gains or losses on their personal tax returns. There's different kinds of partnerships. A general partnership is kind of the basic form, where all partnerships are equal and they're all equally liable. There are things called limited partnerships, where Some of the partners, at least one of the partners has to be a general partner, but other partners can have limited access to the profits and losses and limited liability. You know, as I use the word liability, liability is one of the reasons that you need to consider when you're talking about the form of the business that you want to create. That's why I think a lawyer is, excuse me, important in making these decisions. Chart on just with some comparisons between the two. S corporations, C corporations rather, do have some limited liability. They are not pass-through entities. There's no limits on the number of members and no limits on the type of members. Whereas an S corporation, it is a pass-through entity. That means that gains and losses pass from the company directly to the members. And there can't be more than 100. And yes, there are some limits on the type of members. General partners, there really, in a general partnership, there is no limited liability limitation. It is a pass-through. Again, obviously limited partnership. Some of the partners are limited, but as I said, at least one partner has to be a general partner. Limited liability companies, there is some liability limitation, which is why I think people like to create them. It is a pass-through entity unless it's what's called a disregarded entity. So if you're in business by yourself and you set up an LLC, from the IRS's point of view, that's what they call the disregarded entity. They don't pay any attention to the LLC. That's a legal entity that has no bearing on your federal taxes. And the same thing with sole proprietor. But sole proprietorship, as I mentioned before, there really is no limitation of liability, which is why people like LLCs. But again, you want to talk to a lawyer because LLCs don't necessarily guarantee that if you have some liability, you have some issue with your business, that people aren't going to be able to get at your personal income. Some disadvantages and disadvantages. Income is taxed only once in an S corporation. It can be taxed twice in a C corporation. In fact, the advantages of C corporation, the tax rates are pretty low. They're lower than your personal tax rates potentially, depending on how much you're making. The corporate tax rates may be lower than the personal taxes that you would pay on the money that you took out of your business. And the shareholders are not taxed on the income unless it's distributed. So if it stays in the company, you don't pay tax on it till you take it out. Advantages of S corporations, that losses are passed through to shareholders. You might wonder why it's a benefit to have losses passed through. But if you have losses show up on your tax return, it reduces the amount of tax you have to pay. So losses can be good. Again, capital losses can receive favorable tax treatment. So that's just a summary of some of the possible advantages and disadvantages of these entities. Again, these are things that you want to talk to somebody about and make sure you're making an appropriate decision about the type of business entity that you want to have. All right, let's talk about state entities. I mentioned that before, that this is dealing with the state of Florida, but this is true in a lot of states. The state Florida has an LLC, limited liability company. They also have limited liability partnerships. Those are two entities that you can create in the state. General partnerships, where there's no liability, they're not required to register with the state. So you can set up a partnership and without getting any kind of state license. For-profit corporations, C corporations are state entities, and they're created with the state. An S corporation, there is no specific S corporation at a state level. You create a C corporation, and then you actually petition the IRS to be treated as an S corporation. And once the IRS accepts that petition, then you can let the state of Florida know that you are an S corporation, not a C corporation, and they won't be expecting you to file a corporate tax return. And the other state entity is a nonprofit corporation. So those are the four things that the state of Florida creates. A lot of these things can be done online. You can also, there's lots of organizations that can help you create LLCs or corporations. You can do some of that stuff yourself, but again, it's not a bad idea to have some help in doing that. Sunbiz.org is really another link to that is dos.myflorida.com/sunbiz. And that, take a look at that, you'll see the kinds of things that you can do. All right, let's talk about corporate documents. So if you're setting up a C corporation, you need articles of organization. And these, you can do those online. They're really pretty simple. They can be as involved as you want. And it's not a bad idea anytime you're setting up one of these business entities to have some documentation, especially for corporations or where you have multiple members or shareholders, and partnerships where you have multiple partners. It's really a good idea to get things in writing. It seems easy enough. Let's set up this business. Let's a couple of guys get together. We'll have a partnership. But what happens if you want to add a partner? What happens if one leaves? How do you buy? How does he get out? How does he get his money out? How do you buy him out? What happens if the partnership dissolves? How do the resources and the assets of the corporation and or the partnership get distributed? So those are kinds of things that need to consider and ought to be put down on paper. So filing a C corporation, you do need some articles of organization. You similarly need those same articles of organization for an S corp. Remember, you create a C corp and then petition for it to be an S corp. And the way you do that is you file what's called a Form 2553, requesting that your C corp be treated as an S corp. IRS will send you a notice, and then you pass that on to the Florida Department of Revenue and indicate to them that your C corp is being treated as an S corp, and you don't need to file a corporate tax return. Limited partnerships, again, you need a certificate of limited partnership, and you get that through Sunbiz. Sole proprietor is like a general partnership. You don't have to do anything. You just, no documents required with the state in order to be a sole proprietor. There's one other thing that you can do with your business, and that's to create a fictitious name or a DBA, doing business as. It's a way to basically set up a name for your business. Say you've got the XYZ Corporation, and one of the things that corporation does is plumbing. So you could have a fictitious name rather than XYZ Corporation. You could set up a DBA that's Pete's Plumbing. So you can and then that will be the official name of your business. DBAs are not unique. The fact that you file one of those is just a way to let the as it says, insured public records identify the owner. But it doesn't reserve that name. I think you can have lots of people business called Pete's Plumbing. So it's just a way that can be handy to way to represent your business. All right. So we know we've got some different kinds of we've got 4 different kinds of federal businesses that the federal government recognizes. So how do we let them know what we're doing? So in terms of election, entity election, the way you let the federal government know that you've created a corporation is you do that by filing a corporate tax return. So the first year you're in business, you file a corporate tax return. It's called a Form 1120, and that tells the government that you indeed have a corporation. And after you file that 1120, they're going to be expecting you to file a tax return every year, whether you're doing business or not, until you tell them that you're not in business anymore. So even if you set up a corporation and you kind of, for 1 year, you sort of weren't doing anything with your business, and then you pick it back up again, that year that you didn't do anything with your business, you still need to file a tax return, even if it's all zeros. If you don't, you get penalties. So partnership, same idea. You tell the federal government that you created a partnership by filing a partnership tax return. It's called an 1165. That form, by doing that, again, now you told the government that this partnership exists, and they're going to be expecting to see partnership returns every year until you file a final return indicating that the partnership is no longer in existence. As an LLC, if you're a single member LLC, just one person, the IRS is going to disregard it. They're going to disregard that LLC, and then basically the assumed situation there is that you're a sole proprietor, and they're going to be expecting you to file as a sole proprietor. If you create an S corporation, then your LLC can be, as I said before, can be treated as an S corporation, and in that circumstance, you would file an S corporation tax return and your own personal tax return. So anytime you want to change the treatment that you've requested, you have to file a form and say, yeah, I want to change. Again, these are things where it's good to have tax professional to help you navigate some of these things and make sure that you're getting these tax returns filed appropriately and making the right requests. All right, let's talk about state and local. There are other occupational licenses and permits that are required to do business. Certain kinds of businesses, things like barbers, lawyers, CPAs, cosmetologists, they all have to have a state occupational license. There's a whole list of them. This is a good link called myfloridalicense.com. If you go on there, there's a link on the homepage that says, "Do I need a license?" And when you click on that, it'll list all of the things that require a state license, all the types of businesses that require a state license. So you got to make sure you're looking into that and you have the right license. Again, these licenses are usually require some proof of skill. In other words, you got to take a test. There are other local permits and licenses from some of the cities and counties in Florida. Those are basically taxes. Everybody in business in the county has to pay a tax. I live in Pasco County. We are the Pasco Hernando chapter of SCORE. In Pasco County, it's called a business tax receipt. It used to be called an occupational license, but I think they recognized that it didn't have anything to do with your business. It was just a tax on the fact that you had a business in the county. There are cities within Pasco County that also have their own business tax receipts. Dade, Newport Richey, Port Richey, San Antonio, Zephyr Hills, and St. Leo all have their own separate tax. I had a tax office in Newport Richey, and I had to pay a separate business tax for that plus the Pasco County business tax. Fortunately, in Hernando County, there are no business taxes. There are, in the city of Brooksville, may have a zoning fee depending on if you have a physical, building, possible you might get it, but there are no business. There's nothing like the Pasco County business taxes in Hernando County. So that's just kind of a quick rundown of state and federal business entities and taxes, things that you need to make. You just need to make sure that you've touched all the bases with these state and local licenses, and that you have everything you need when you get started with your business. All right, let's talk about business taxes. These are both federal and state taxes that you need to pay as part of being in business. So in terms of federal taxes, we're talking about payroll taxes, FICA, which is Social Security and Medicare, the FUTA, which is a federal unemployment tax, and of course, income tax withholding, and all employers. So if you're in business and you got employees, all employers are required to withhold federal taxes, Social Security and Medicare for all their employees, and they're required to pay those taxes on a quarterly basis to the federal government. Other taxes in terms of federal taxes is a federal income tax on corporations. Remember, the S corporations and partnerships have to file returns, but they don't have to pay business taxes, federal taxes, but the corporations do. In terms of state taxes, if you're selling things, you need to pay sales and use tax. You collect the tax, and then you need to pay that to the state on a regular basis. And we'll talk about kind of how that goes. If you have employees, you also have to pay reemployment tax. Florida euphemistically calls their unemployment reemployment tax. And you may also have to pay state income taxes if you have a corporation that's taxed at a state level and a corporation's taxed at a federal level as well. Okay, let's talk about payroll taxes. All payroll taxes need to be paid to the IRS on a quarterly basis. The employers pay half of the Social Security and Medicare tax, and employees pay the other half. So when it comes time to pay at the end of each quarter, you've collected the withholding from you've withheld the withholding from your employees, and you've also withheld half of the Social Security and Medicare taxes that are due. Then you, as the employer, have to provide the other half of the Social Security and Medicare taxes, and make that payment at the end of the quarter with all that money. You do that by filing a Form 941. You do one of those every quarter, and even if you don't have any taxes to report, you're still required to file a 941. So again, if something happens and you stop your business for a period of time, you really didn't do anything for a quarter, you didn't have any employees, you still need to file that 941 until you tell them, until you indicate, and there's a place on the tax form to indicate that's the final return. Till you do that, the IRS is going to keep expecting you to file those taxes. And they get real upset when they don't see these, especially these things that are involved with withholding and FICA. They want to make sure that money is getting paid appropriately. You can file these taxes. You can file those 941s by mail or online. Electronically, it's much easier to do that electronically. And you also need to pay that electronically. You can't send a check in. It's got to be done electronically, usually by a direct debit from a business bank account. There's a system called EFTPS, electronic funds transfer payment system. I think that's what that stands for. And you use those to pay your current tax liabilities. So every quarter, you need to file a 941, and you need to make a payment with EFTPS to cover those quarterly taxes. If the business is small enough and the total of your Social Security and Medicare for the year is less than $1,000, you don't have to pay that every quarter. You can just pay it once a year. But that's pretty rare. You'd have to have a pretty small outfit to be able to be doing that. Okay. Some other federal taxes. FUTA, the federal unemployment tax, is kind of similar to state unemployment tax. It gets paid once a year on what's called a Form 940. Now, who has to pay federal unemployment? Well, if you paid wages of $1,500 or more to employees in any calendar quarter, in this case for 2023 and 2021 or 2022, you'd have to pay FUTA for those people. If you had one or more employees for at least some part of a day of 20 or more different weeks in 2021 or 22, then you're required to pay FUTA. That means if you have somebody work for you an hour a day and they did that had that hour's worth of work in each of 20 different weeks, then you're required to pay federal unemployment. I know that sounds kind of silly, but that's the way the law is. If the federal unemployment is more than $500 for a calendar year, then you have to deposit quarterly. It's pretty unusual to get a very large FUTA payment, because you get credit on the federal unemployment for what you paid to the state. So basically there's a total unemployment liability, a little bit for the federal, and the bulk of it goes to state. So let's talk about the state unemployment. Well, let's talk about state sales tax first. If you're selling things, selling, renting, leasing, licensing certain properties and certain kinds of services, there are some services that also require that sales taxes be paid. It's not just on selling hard goods. The base rate in Florida is 6%. There are discretionary taxes from 0.5% up to 2.5%. Now, it used to be just 1.5%. That's discretionary, usually at a county level. Here in Pasco County, we have a 1% discretionary tax. So the sales tax rate here is 7%. I know over in Orlando and Orange County, there's only a 0.5% discretionary tax. So sales tax over there is 6.5%. So how much sales tax you owe depends on where you're doing business and where you're selling product. Use tax is basically the same as sales tax. It applies to goods that you might have purchased outside of Florida and not paid any sales tax on, and then you decided you brought something into the state expecting to resell it, and pay the sales tax on that resale. But then you ended up using that for your own business. Say you bought a computer thinking you were going to resell it, so you didn't pay, you bought it without the sales tax, and now you decided to use it for your business, for yourself. You owe the sales tax on that because the state didn't get it. That's a use tax. So both sales tax and use taxes are the same rates and apply to the same places. So if you're selling goods, you're selling, renting, leasing, things like that, and providing some certain services, you will owe the state a sales tax. Now you can add that tax on. You sell something for $1, you add 7 cents. The total is $1.07. Or you can sell something for $1. You take 93 cents, and the other 7 goes to the state. How you price the tax is kind of up to you. So, as I mentioned, some services are subject to tax. Non-residential cleaning services, commercial pest control. My favorite is detective services. You know, why that is subject to sales tax, I'll never know, but it is. You have to register to pay the sales tax. You set up an account, and you do that with floridarevenue.com. On there, you can go online, you can file a return, and you can pay. You basically give them again the information of your business bank account. You go on, you file a tax return, and they'll debit the money from your bank account. So it's not, the paying the sales tax is not a bad process. This is kind of how often you have to pay. It can be anywhere from annually to monthly, depending on the amount of tax that you collect. So if you collected more than $1,000 in sales tax last year, then you're going to have to pay monthly this year. Okay. So let's talk about unemployment or reemployment tax. Again, the rules for the reemployment are the same as they were for the federal, actually a few more. But basically, if you had a quarterly payroll of $1,500 or more in a calendar year, or again, you had somebody working periodically for you in 20 or more weeks during the year, then you're required to pay unemployment for those people. Now, the nice thing about unemployment is, again, anything you pay to the state ends up being deducted from the federal that you owe. The way that unemployment works is for the first 10 quarters that you're in business, you're paying a tax rate of 2.7%. So 2.7% of your payroll is you have to pay as unemployment tax. At the end of that time, they recalculate, and it's based on the usage. Basically, you're paying into a pot of money. And so if you've got a lot of employees that are leaving and filing unemployment, and the money from your pot is being depleted, then they're going to adjust the rate. The rate could actually go up as high as 5.4%. But if at the end of that 10 quarters you haven't had any claims, then the rate is going to go way down. And the lowest it'll go down to is about 0.6%. So a lot of people, especially people in business for themselves that are paying themselves a salary, they're usually only paying 0.6%. But again, this is something that needs to be done and filed on a regular basis. More areas where other people can help you. Business income taxes, again, all corporations, both C corporations and S corporations, have to file every year, even if there's no income. Partnerships have to file every year, even if there's no income. And sole proprietors, you're filing with your individual tax return, which, again, you have to file every year regardless. And generally, the C corporation is the only thing that's subject to income tax. There are some really specialized cases where an S corporation might have to pay an income tax, but those are pretty rare. Okay. So who has to pay taxes in Florida? Business taxes. All the C corporations have to pay a tax in Florida. If an LLC is classified as a corporation for Florida, again, you need to file a corporate tax return. And tax exempt organizations, if they're doing what's called unrelated trade or business income. So you have a tax exempt organization with a certain purpose, but they do some side business to raise money, and that side business isn't really related to their tax exempt purpose. That can be taxable, and it's also taxable at a federal level. All right, let's talk a little bit about business insurance. Number of different types of business insurance. First of all, just general liability, breach of contract, general lawsuits. A good idea, depending on the business that you're in. If you're providing services for people, good idea to have liability insurance. Errors and omissions, again, if you're possibility of being held responsible for not delivering expected results, lawyers, accountants carry error and omission insurance in case they make a mistake and could get sued. Property and flood insurance, if you've got physical assets that you're keeping someplace or you have a building, you definitely want to make sure that you have the right property insurance and flood insurance if you're in an area where that could happen. Business interruption insurance is another useful form of insurance. If something happens, a hurricane, and you're out of business for a few months, business interruption insurance can help with that. Home offices are popular with small businesses. People don't have a physical location; they work out of their house. But if you've brought equipment home, you set up an office, you got computers, you got other things that are part of your business, they might not be automatically covered by your homeowner's policy. So you want to make sure that you update that homeowner's policy to cover anything that might be in your home that is part of your business. And Florida workers' comp, if you've got employees, you're going to have to provide workers' compensation insurance for them. Usually, if you use a payroll company to help with payroll, which is a good idea if you've got employees, because the payroll companies can handle all of the all the business taxes and withholding and all of that. Plus, they can usually come up with workers' comp as well, so that if you're a single employee, you don't have to pay workers' comp for yourself. So as a sole proprietor, that's not required, but if you've got employees, something that is required. All right, let's talk a few minutes about record keeping. You need to keep detailed records about your business. It talks about keeping paper records such as receipts and invoices. They don't have to be kept on paper. You can scan them and keep them electronically. Those are all acceptable. Any type of electronic storage is acceptable, but you need to keep details. If you're declaring expenses on a tax return, and the only thing you've got to prove it is a credit card bill that says I spent, $300 at Home Depot. The IRS, if an audit comes along, the IRS isn't going to accept that credit card statement. They're going to want to see itemized details about what it was that was in that $300, and you're going to need to be able to relate to why that wasn't personal and why that was a business. Those were business items that you bought. And the way you do that is with the receipts and invoices, the detail. So it sounds like a lot of work, and potentially it is, but that's what's necessary. And it's also important to keep track of all that stuff so you know how much money you are spending, and you can you can come up with a P&L and a profit and loss and understand how your business is doing. So I know some of you may be using QuickBooks or some other product like that to keep track of books. It's important that you enter all your transactions, all your receipts and all your income and all your expenses, and that you actually have backup for those that income and expenses. A lot of this is all geared towards ultimately being audited. Tax auditing is a random process. It's a sampling. IRS will randomly sample different classes of tax returns to see if how the tax laws are being upheld. They will focus on certain areas where they know historically have been problem areas. One of them is small businesses. They might tend to audit small businesses more than larger ones, for instance. But if you've been involved in an audit, let's put this way: you don't want to be involved in an audit. I've worked with a number of clients who have been audited, and it's not necessarily a pleasant experience. If you've got the records and you can back up your tax return, it goes fine. If not, it can be kind of painful. So you really need to keep supporting documents for as long as necessary. So, if you got equipment and you're depreciating it over time, you got something you're keeping and depreciating for 10 years, you should keep the documentation about what you spent on that and what you've done with that equipment for that 10 years so that it's available, because there may be tax consequences at the end of the life of that equipment. So the time to keep records kind of depends on what they are, but in general, probably 5 years is a reasonable amount of time to keep tax records. IRS can only audit you. They can only go back 3 years in an audit, unless they've seen something that they might consider a systemic problem, something that they looked at 3 years of returns and you were making the same mistakes on all. You were making these incorrect deductions on the last 3 years of tax returns. They might go back a couple more years. They can do that at that point. So it's always a good idea to keep your receipts and your details for a reasonable period of time. But it's having those records is important for doing an accurate tax return and being able to defend it in case you should get audited. All right, estimated taxes. If you're in business for yourself, if you're a sole proprietor, for instance, or an S corporation, and you have income, but there's no withholding, then you should be paying estimated taxes. Otherwise, you're going to end up with a big tax bill at the end of the year, and there'll be penalties associated with that, because IRS expects you to be paying the majority of the tax that you owe throughout the course of the year, not waiting till the end and paying it all. So the rules are that by the April 15th due date, you have to have paid at least 90% of the taxes that you owe for that tax year. Or you need to have paid in an equivalent of 100% of the tax you paid last year, or owe less than $1,000. If one of those conditions is true on the amount of money that you paid in, then there's no penalties. If you don't satisfy them, if you owe more than $1,000, for instance, you can be assessed a penalty for late payment, because the IRS, as I said, the IRS is expecting you to be paying over the course of the year. So, as a sole proprietor, since nobody's withholding your income tax, you want to make estimated payments, and they're done. They call these quarterly, which I never have understood, because it's April 15th tax due day. June 15th, September 15th, and then the 15th of January in the following year. So they're not exactly quarterly payments, but those are the dates when these payments, when your estimated payment tax payments are due. And they're filed on this form called the 1040 ES. You basically just fill out the form, send in the money, and it gets credited to your account at the IRS, so that they'll know that the money's there at the end of the year. Something something you don't want to leave out, because it can end up being expensive in terms of penalties. All right, I mentioned a couple of times about why it's not a bad idea to have a paid tax preparer. Tax code is about 60,000 pages. It's growing every day. It changes all the time. And your time is way too valuable. It's way better spent focusing on the important things that will make you money, rather than fiddling around worrying about preparing tax returns. Even Albert Einstein thought taxes were complicated. This is a great quote from him, and it's an actual quote. And Einstein actually would send his, in those days, they mailed out blank tax forms to everybody. And Einstein would mail them back saying, just let me know how much I owe. So he didn't even want to mess with that. So you shouldn't either. All right, we got some time, a few minutes for questions. Let's see what we got. Any? Okay, there are a couple questions. Yeah, the first question was about an LLC. And as a single member LLC, by default, the IRS is going to treat you as a sole proprietor. If you don't create an S corporation as within that LLC, if you don't elect to have that LLC treated as an S corporation, then you're going to be then your taxes are going to be part of your personal taxes. That's just the nature of the business. A single member LLC, it doesn't really keep you. If you create an LLC and you're a sole proprietor, if somebody sues you, they're going to be able to go after your personal income. You can't just say, well, that's my business and I only got $10 in the bank, so that's all you can sue me for. They're going to be able to look at your personal income, personal holdings, personal assets, as well as your business assets. So that's why I said you want to talk to lawyers about this kind of stuff, because the real reason to have LLCs and S corporations and things like that is because of liability. Yeah, I had a question about, we're going to get linked to the class. What I do is I will send out a link so that you can go through this webinar again. We usually don't distribute the slides, but I will distribute a link to see the recording of this presentation. Other question says, as a single member LLC, can I create an S corporation? Yes, it's just a matter of filing again this 2552 form with the IRS, asking to be treated as an S corporation. And that's something that you need to do if you want to be treated that way. Again, these are things that a tax professional can help you with. Okay. Anybody else have any questions? Oh, well, this question, what's the benefit of becoming an S corporation? Well, there are some tax benefits to being an S corporation, but there's some liability, there's some financial reasons not to. If you create an S corporation, you have to file an S corporation tax return. which costs money. Generally, you'll have to pay somebody to do that. And you also then have to file a personal tax return. You also, as an S corporation, you're required, as a sole proprietor, you don't pay yourself a salary. Remember, I said your finances and the business finances are all in one. So there's not a distinction. You don't pay yourself a salary. But as an S corporation, you have to pay yourself a salary. So that means you have to have a payroll, and you have to withhold the payroll and social. So you have to withhold payroll taxes and pay them on a quarterly basis. Things like that. You got to pay unemployment. So by creating an S corporation, you take on some additional responsibility. But depending on the circumstances, there can be some benefits to have an S corporation, even though you incur those other expenses. And the best thing I can tell you is that it takes some analysis to answer that question. What's the right thing for you to do? And again, that's something a tax person can help you do. So, okay, all right. Appreciate everybody's attendance, and don't forget, if you need some help, please contact SCORE and ask for a mentor, and we'll be happy to help you with whatever issues are coming up in your business. All right, everybody have a great day. Thanks for attending.